Hi, Bill Bodner, Mortgage Market Guide. Thanks for tuning in to our MMG weekly recap. So, up on the screen on a Thursday, we see mortgage-backed securities losing a little ground. And overall, if we look at pricing, we had a nice couple of weeks, and not too surprisingly, pricing starting to gather near that 50-day moving average, not able to break away from it. We were hoping yesterday that we were making a move away from it, and on that Wednesday, we were really going along. Things were going along nice, and all of a sudden reverse lower. So as we head into this Friday, we have jobs report tomorrow, obviously a very important number. And with the first half beyond us, let's just recap where we've been. We had the 10-year note at 147 today, right? 145, 144 yesterday. Stocks hitting NASDAQ, hitting all-time highs. Inflation running at 5% year over year. So now as we go into the second half, it's all about when is the Fed going to taper bond purchases. And it seems like every day there's another Fed president or governor on the phone, on TV or doing speeches talking about maybe the need to remove some of that accommodation. Now, when they talk about that, what we're hearing are more whispers, and even a Wall Street Journal article, and the Wall Street Journal is typically a mouthpiece for the Fed. They're talking about when they do this taper that they start right in our world by removing or starting to buy less and less of mortgage-backed securities. And remember, they're buying $40 billion worth per month, and it's their buying that is actually keeping home loan rates relatively low. They're certainly putting a limit to how high rates can go by buying bonds. So if they come out of the market, that means that void has to get filled, and certainly people will buy it, but it's at what price? So there's probably going to be upward pressure on rates in the second half that we need to be mindful of. We look at the chart, a couple things that I see glaringly is this 101.50 is a ceiling. If mortgage-backed securities can't get above this 101.5, rates can't get any better. It's that simple. And I think in talking with borrowers, it's important to share with them that the pricing disconnect, we're seeing the 10-year note again at 145, yet mortgage-backed security pricing has not improved. So those instruments are going in a little bit opposite directions of late, and that's going to be a challenge for you to be sharing with clients. But I think over the next couple of months, what it's all going to be about is the data. How does the inflation numbers come in? Is high inflation going to indeed be transitory? The labor market picture. We have a jobs report tomorrow, and we're going to have to see those next couple because that's at some point the Fed may be thinking about ultimately, hey, we need to be buying less bonds and stop adding to the froth in the housing market. So I hope this finds you well. Have a great weekend. We'll talk to you soon. Happy 4th. Bye for now.